In 2026, a lot of people feel like they did the right thing with money and are getting punished for it. They saved in the bank, bought certificates of deposit, stayed away from risk. Now, prices are still high. Central banks are talking about rate cuts, and that safe money feels like it's quietly dying. If that's you, I want to talk to you directly because you're not imagining it. Across the developed world, economies are slowing, job growth is weakening, and there is rising pressure on central banks to cut interest rates to support growth. At the same time, inflation hasn't disappeared. In the U.S. and other major economies, price increases are still hovering closer to 3% than the 2% target central banks like to talk about. When rates come down and inflation stays sticky, it creates a kind of saver's trap. Savings accounts and new CDs start paying less. Prices in the store and on your bills don't fall back to 2019 levels, so each year the real buying power of your cash leaks away. I've been warning about this kind of thing for a long time. Years ago, I wrote that currency-based investments, things like cash and long-term bonds, are among the most dangerous of assets in an inflationary world. They can look safe because you get your interest and your principal back, but over time, they quietly destroy your purchasing power, even while the statements look calm. In 2026, that warning is playing out again. So what's the only way to truly save your money, meaning preserve what it can do for you, not just for the next 12 months, but for the next 10 or 20 years? For me, the answer is a three-layer approach. Layer one is the part every human being still needs, even if it loses a little ground to inflation. A small cash buffer for security and optionality. I'm not telling you to get rid of cash. Cash has two jobs. It protects you from having to sell assets at the worst possible moment when life throws you a surprise. It gives you options, the ability to act when an opportunity appears. In 2026, with an economy that could slow further and unemployment that is already ticked up. You absolutely want a rainy day fund. That means money in a basic savings account, a short-term money market fund, maybe a short 400. If the rate is decent, that cash will probably not beat a 3% inflation rate. But it keeps you from ruining yourself. It keeps a job loss from turning into a foreclosure. It keeps a car repair from turning into credit card debt at 20%. It keeps you from panic selling your investments at the bottom just to pay the bills. Think of it this way. Your emergency cash is allowed to lose a bit to inflation in exchange for protecting you from much bigger permanent losses. The mistake savers are making in 2026 is not holding some cash. It's keeping almost everything in cash and savings accounts, where every year inflation quietly eats a chunk of their future. Once you've got layer one, a modest buffer for 3-6 months of essential expenses, anything beyond that should start migrating to layer two. Layer two is where you put the money you actually want to save in the real sense. Money that needs to grow, or at least keep up with inflation, not just sit still. Here, I've been consistent for decades. The best way to preserve and grow purchasing power over long periods is to own productive assets, particularly businesses that earn good returns on capital. Don't require huge reinvestment just to stand still. Have the ability to raise prices when costs rise without losing customers. In one interview about inflation, I explained that a strong protection against rising prices is to hold shares in businesses that can increase prices with inflation and do not need constant heavy capital investment. Think of a consumer company with a strong brand that can nudge prices up a bit each year. A software or network business where adding one more customer doesn't require building another factory. Other asset-light franchises where more of the extra revenue from inflation flows through to owners instead of being swallowed by higher capital costs. These kinds of businesses are very different from currency-based assets. Cash and bonds promise you nominal dollars that lose buying power over time. Quality businesses over long spans can grow their real earnings along with or faster than prices. That's why I've always encouraged ordinary investors to own a broad basket of equities, usually through a low-cost index fund, and to stay invested. You're not speculating on tickers. You're owning slices of real businesses serving millions of customers. In 2026, with inflation likely hovering closer to 3% than 2%, and the prospect of rate cuts gradually reducing the appeal of simple savings products, the second layer is more important than ever. That doesn't mean you throw everything into the hottest stock you find. It means you keep your emergency cash out of harm's way. Put your long-term savings into assets that can plausibly outgrow inflation, broad equity funds. And if you understand them, some carefully chosen individual businesses are real high-asset businesses with real steady income. You accept that prices will move around. You don't rip money out the moment the market falls. You judge success by decades of purchasing power, not by this quarter's account statement. Now we come to layer 3, the part most people ignore, but I consider the best investment by far. That layer is you. In my view, the greatest inflation hedge, the greatest saver of money over time, is not a stock or a bond or a piece of property. It is your own earning power. I've said recently that investing in yourself is the most advantageous investment by a wide margin, because your skills can't be taxed or diminished by inflation. I told shareholders that the best safeguard against inflation is your own earning potential, becoming so good at what you do that people are willing to pay a premium for your work. Why do I talk that way? Because when prices rise, a bank account just sits there. A bond pays a fixed coupon. But a person with rare, valuable skills can often raise their income through higher wages, promotions, consulting, or business profits. In a noisy 2026 world with AI changing job descriptions, companies cutting back, and entire industries restructuring, the people who do best are the ones who have skills that are hard to automate, are known for reliability and integrity, keep learning so they can move sideways or upward when their old role changes. That's not motivational talk. It's a very practical form of saving. When you take a course that gives you a better paying certification, improve your communication so you can lead, sell, and negotiate. Learn about your industry so you can step into higher value roles. You're making an investment that often yields thousands of dollars more per year, year after year, for decades. There's no bank account in the world that can match that. And unlike a capital gain, the growth of your underlying ability is not taxed. Only the income it produces is taxed, and you'd pay tax on income no matter where it came from. So when I talk about saving your money in 2026, I'm not just talking about where you park the dollars. I'm talking about how you allocate a portion to protect you, a portion to grow ahead of inflation, and a portion of your time and energy to developing the one asset that makes all the others easier to build. Let's turn that into a simple copy and paste plan an ordinary saver can actually follow this year. Imagine you have $10,000 in total savings, and you're worried that keeping it all in the bank is quietly killing its future. The exact numbers don't matter. Use the percentages. First, you decide what you truly need as layer 1 emergency cash. For many people, that's somewhere around 3-6 months of essential expenses. If your essentials are $2,000 a month, that might be $6,000, $12,000. If your current savings are lower, you build toward that over time. That layer goes into a savings account, a money market fund, or short-term instruments that you can access quickly. You accept that if inflation runs at 3% and your savings yield average 23%, you're roughly standing still or losing a little. That's the price of safety and flexibility. Next, everything beyond that emergency buffer becomes layer 2 money that should not sit in quietly dying cash if you don't need it for years. That money moves gradually into a broad low-cost equity fund for many, an S&P 500 or global stock market fund, potentially a small allocation to other productive assets you understand, such as real estate businesses if they make sense in your situation. You add to this layer on a schedule every month or quarter. When you get paid, you send a fixed amount into this investment bucket. You ignore short-term headlines and remember that saving is about purchasing power in 2036, not the CPI print next Tuesday. Finally, you carve out some resources time, energy, maybe a bit of money for layer 3. That might be a certification that raises your pay, a course that moves you into a better field, books and training that make you better at sales, management, or a technical skill. Even if all you can do is commit one evening a week to serious learning in your field, that's investing in the asset that will do more to save your money than any savings product, your ability to earn, adapt, and demand better terms from the world. So, when you hear that cash is quietly dying in 2026, here is what I want you to remember. Cash alone is dangerous in an inflationary rate tight cutting world because it lets you feel safe while your real wealth slips away. Cash is layer 1. A reasonable buffer is still essential even if it loses a bit to inflation. True saving happens in layers 2 and 3, owning productive assets that grow faster than prices and making yourself more valuable so you can earn more and invest more. You don't have to guess the perfect fund or the perfect stock. You don't have to predict exactly what central banks will do in June or October. You just need to stop treating cash as the finish line and start treating it as the starting point, the foundation on top of which you build assets and abilities that inflation can't silently destroy. If you do that, then 2026 doesn't have to be the year your savings die quietly in the bank. it can be the year you finally put your money and yourself somewhere it can actually live.